So now we want to challenge both the private side and the public side and see how you actually can manage to set up such partnerships in a successful way, how you can address challenges, how you can overcome them. And for this, I now hand over to Maria Teresa Zappia. She's the moderator of our first panel. Maria Teresa is Chief Investment Officer at BlueOrchard and has been active in the emerging markets finance sector for over 20 years. She has worked for several development banks and financial institutions such as EBRD, Asian Development Bank, the Overseas Development Institute, and even the OECD. And she was both based in the field, namely in Africa, Southeast Asia, and Central Asia, but also in the respective head offices. I hand on to you to introduce your panelists. And the first panelists, please join us here on stage.
Good morning to everybody, and I have to say it's an honor to be here, and I invite my panelists to be on stage. A few words, just setting the stage. We heard quite a lot about the role of the private sector in achieving the SDGs. We have heard very big numbers. The trillions have been floating and in the introductory remarks about the financing gaps. And our session is really, with our distinguished panelists, our section is really on challenging the public sector. So what can the public sector do to attract more private capital? And I'd like to say not only private capital, but really know-how, expertise, so much more than just the dollars. To do this, I have a very easy job, because I have a very distinguished group of panelists. And ladies first, I'll start with Claudia Arce. Claudia has been with KfW for a pretty long part of her business career. She also has worked for the UN agencies FCCC on designing the Green Climate Fund. But more importantly, where I think the expertise of Claudia will come in today is that she has led two very successful public-private partnerships. One is the Microfinance Initiative for Asia, which BlueOrchard has the honor to manage, and the Global Climate Partnership Fund. So in these two structures, we can certainly pick the brain of Claudia on what works and what it doesn't. So close to Claudia, we have Ivo Germann. We heard quite a lot of speakers already from SECO this morning. What I think it's interesting is that Ivo is the head of operations of Economic Development Cooperation today, but also has been the head of the private sector department. And Ivo has played an important role in institutionalizing CFM, which is effectively the Swiss DFI, so brings in both DFI experience at the CFM level and at the SECO level. And close to Claudia, we have Nick O'Donnell as the CEO of the CDC Group, so the UK Development Finance Institution. And Nick has been with CDC since last year, but is not new to impact investing. In fact, he was with Bill and Melinda Gates Foundation before. He also was the CEO of the Big Society Capital Bank. And prior to that, he was really in the private sector with JP Morgan and Goldman Sachs. At the far left, my left, we have Orlando Ferreira. Orlando comes from IDB Invest. I'll say a few words because this is a new name. So I think it's a rebranding of the IIC, so the Inter-American Development Bank Investment Corporation, so the private arm of the Inter-American Development Bank Group. Orlando is the Chief Strategy Officer there and used to be the Chief Operating Officer. and has covered a number of positions in the Inter-American Development Bank. But before that as well, he was in the private sector back in Paraguay in the financing and construction. So as you can see, we have a good mix of experiences. And I will not spend any more time talking and go and join my panelists for some hot questions, because the topic, as we said, is challenging the public sector. So I guess my first question is to all of you, but maybe we can start with Claudia. Something that we have talked about, and I think Karin did an excellent job in talking about de-risking measures and instruments to attract the private sector in generally public sector structures, at least at the origin. So my question to Claudia is, what are the instruments that, for example, in KfW you have been using to really attract private capital and private expertise in achieving the SDGs?
Yeah, it's working. Yeah, good morning to everybody. It's really a pleasure to be here, especially on this first panel on public-private partnership this morning. Yeah, so as you heard, I come from KfW. KfW is a little bit a different development bank because the biggest mandate is within Germany and Europe, and the smaller mandate is the international mandate. But in fact, the most important part to attract private investment and private capital within KfW Group are the pure capital markets. And we are fortunate that we are AAA rated due to our government structure, which makes it much easier to attract private capital. So every year we attract more or less 70 billion euros in private capital. And out of this private capital, quite a substantial part is also being used for investment in emerging markets. Last year this was more or less 6 billion of funds which were directly going to emerging markets in the development bank, and another 20 to 25 billion going through our commercial arms, which is the IPEX Bank on one hand, and DEG, which is our sister organization, a little bit similar to the structure of World Bank and IFC within Germany. Also, we managed quite happily to launch green bonds in 2013, which nowadays are it's a portfolio of more than 10 billion euros in green bonds. And definitely this is very attractive for private investors because it's listed, it's high liquidity, it's easy going, and it has an impact. Apart from this, and these are the things Maria Teresa just mentioned by introducing me, are more specific impact funds. And here we started roughly 15 years ago, even a little bit more, with specific structured funds, which normally are launched in Luxembourg, but also in other markets, where we really try to bring private capital, DFI capital, so to say KfW's money, and German budget funds mainly, or at the beginning only German budget funds. Now it's a little bit wider together. We try to structure these, and by this we, like the speaker this morning from IFC was saying, we try to de-risk risks for both, in fact, because always people here speaks on de-risking for private sector, but you also have to de-risk for public sector, not in terms of return, but in terms of impact. So public sector very much looks at impact figures, private sector looks at return, and sometimes I feel one part wants the de-risking, wants a lot of return with no financial risks, and the other ones want a lot of impact with no risks in the projects. So I think there it's a little bit the roles of MDBs can play bridging this. And in instrument, it's all kind of instrument. It's equity, it's mezzanine, it's to some extent guarantees. It's also creating instruments for local financing and things like this. But I would like to stop here because otherwise it's getting too long.
Perfect. Thank you very much, Claudia. And I guess we will give the floor to Orlando to move from kind of the global South Asia to Latin America and see what has been done there by IDB Invest.
Going to your specific questions, beyond what you all know, are absolutely familiar with, what do we do to bring in private sector partners to our deals? Beyond the B loans and the B bonds and partial credit guarantees that you all know well about, and maybe later I'll have a couple of minutes to tell you about this new thing that we're doing at the IDB Group. But there are two things that we are exploring. We have a small group within IDB Invest, our new organization, that is focused on trying to find new ways to work with the private sector. We call it the Financial Products Group, and they're thinking every day of what else can we bring to the table. And we're working on two things right now. One is local currency, beyond what we've done in Mexico and Colombia and Peru and Brazil and Argentina, which are the low-hanging fruit, the easier places where we can get local currency funding. We're now testing a couple of models in Paraguay and in the Dominican Republic, which is a combination of working with pension funds and also issuing local currency bonds in those markets. And so that's one area that we're exploring to try to bring the private sector. And also, we're exploring a new type of trade finance products, and those are in a very advanced stage of evolution. So, and that also links up to the issue of de-risking and what can we do in that area to support private sector investment. So that's specific to your question. And in terms of what we're trying to do, is essentially rethink the way the IDB Group had been looking at Latin America from the private sector perspective, and trying to bring together the strengths that we had and really focus on becoming a bigger player in the region. But later maybe we can talk a little bit more about that.
Great, thank you. And maybe we move to Nick, who just took the mic, so it's ready.
Thank you.
To CDC, and CDC is sort of the mandate is really Africa and South Asia. So again, good combination and sequel to Latin America.
Yeah, thank you, Maria. Good morning, everybody. It's a pleasure to be here. Just a quick introduction on CDC. CDC is the oldest development finance institution in the world, having started in 1948. So this year we'll be celebrating our 70th anniversary. I suppose what makes it a little bit different from some of the other DFIs is, first of all, the fact that we're 100% equity financed by DFID, the International Development Department of the UK government. So unlike many of the other DFIs who have more of a bank-like structure, we have more of an investment company structure, which does give us the ability, I think, to take more risk ourselves. And indeed, the percentage of equity in the balance sheet, the CDC today has about a £4 billion balance sheet. The percentage of equity is about 75%, or the investment on the 75% of the assets are in equity, which makes it a significantly larger percentage than most of our DFI peers. And then, as Maria said, we're also, since 2012, have been focused very much on what DFID believes are the poorest countries, and so specifically for us that means investing in Africa, largely sub-Saharan Africa, and in South Asia, so India, Bangladesh, Pakistan, and Myanmar. So again, unlike some of our other competitors or peers, we are we don't invest globally. We don't invest in Latin America. We don't invest in large parts of Asia, and I think that gives us. Obviously, you miss substantial opportunities to create impact in some of those regions, but specifically, it does make us much more focused, and I hope much more expert on the areas that we are actually working in. Historically, we've never had, the specific question was around instruments and what instruments you have to provide to sort of, if you like, leverage in the private sector investors. Historically, we're not obviously a donor agency. We don't have any grant capital. All our capital is invested rather than granted. So we don't have specific, what I guess I would describe as subsidy programs or risk mitigation programs. We don't have something that Karen described, anything that like Karen describes as a private sector window. But what we do have is a real need to partner with private sector organizations on transactions. We have access to significant numbers of transactions. Many of them are of institutional, what you in the audience would consider institutional size. So our average equity investment in Africa is has an average size of about $35 million. So large transactions, and very often in many of those we look to find partners to work with us, and sometimes those are in infrastructure, sometimes they're in agriculture, sometimes they're in financial institutions. And we have a very active effort of working with other partners around the world on those. We're also obviously a significant investor in funds. I think we're the largest LP in African private equity funds. Many of those funds we have cornerstoned and helped to develop and originate, and we play an active role in trying to bring other private sector money in alongside our DFI money into many of those funds. And then we are obviously located in one of the world's, or possibly the world's largest financial center. We have significant experience in all our markets. We understand risk in those markets, and we have data that we can look at to help us better understand what risks are. And I think as a general point about Africa specifically, one of the challenges of leveraging private sector money into Africa is the data suggests that the degree of risk that you take when you invest there is actually overestimated. It's not as risky in investing in African infrastructure as perhaps many mainstream developed country financial institutions would like to think. So we've had significant successes over the last, certainly over the last 4 or 5 years in partnering with private sector companies. Sometimes those are large banks. We did a lending facility in Sierra Leone, right sort of at the height of the Ebola outbreak, to try and address the fact that the credit, together with Standard Chartered, to try and address the fact that the credit markets there had pretty much frozen. We've done some very interesting work recently with companies like Lafarge or like Unilever, more recently AP Muller. So companies, big, large multinational companies that have real expertise in markets and we'll talk I think later about what different parties bring to the table. But increasingly we're dedicating resources within CDC to building those relationships, not just with banks and financial and investment managers, but also, as I say, more broadly with companies, big multinationals that are active in our markets every day.
Thank you very much. That's perfect. And I guess closer to home and closer to my seat, Ivo, the experience of SECO, I remember when we talked, you also said you'd like to say a few words also about, your sort of double head of CFM at the same time. So same question, what are the instruments? And maybe we can also move into the second topic, which is also, linked to the instruments, any lessons learned. What works, what doesn't work when we want to attract private sector capital in public, structures or working with the public sector.
Well, thank you, Maria Teresa. Good morning, everybody. I'm excited to be here, talking about an exciting topic and an exciting role, as I think, also for us as SECO, which is a grant provider. So it's not the same thing, but that makes it interesting because we can team up and then see how we can really move the market and create new asset classes. So really what we do is across the whole spectrum, from long-term technical assistance, which very often, and with partners such as KfW in the infrastructure space, we provide the technical assistance for the soft side, for the technical assistance that is needed to then unlock some of the credits that brings in the private sector. So let's not underestimate the role of pure grant as a contribution to unlocking private sector finance. But then, interestingly, we ventured also very early on to more risk-sharing type of arrangements, surely not fully commercial, or let's say high-risk commercial. So we have to calibrate very carefully what we do because it's public funds, and we want to bring in the private sector rather to push it out. And that spans from startup finance to green finance that was mentioned already a few times, also looking ahead in some of the exciting ventures that we have with IFC, with others, but also MSME finance, infrastructure I mentioned. Infrastructure is an interesting example as well, because there we team, for instance, with Pitch, the private infrastructure development group, present today here as well, where we support different instruments or facilities from risk capital for project preparation to really create markets in a sense that you contribute to making bankable projects, to the more credit enhancement parts, guarantee facilities for local currency lending. Another one of my topics, my pet topics, is local currency, where I think a clear role for the public sector to not only de-risk, but really I think to put the risks where they should be, and that's clearly with the donors and not the local financial sector and the beneficiaries. So that's on SECO side. As you mentioned, that kind of double head. Why double head? Because CIFEM, the Swiss DFI, is also fully owned by the government. So we are the kind of owner and guardian authority of CIFEM, and we perceive it as one of our strong instruments in economic development cooperation. So what does CIFEM? CIFEM does roughly 50% debt and 50% private equity in priority countries of the Swiss Confederation, mostly through local funds. So we do have some international fund managers that where we provide SECO side, some first loss capital, for instance, with KfW, the Sanad Fund in Northern Africa. But CIFEM works mostly with local fund manager, bringing a local fund manager to fruition, and then try and really work through maybe 2 rounds before then the private sector takes over. Now to maybe your second part of the question, what works, what doesn't. This week we're going to talk about the first social impact bond in an emerging market in Colombia that SECO, together with me from the Inter-American Development Bank, supported. So we're very excited about that. Is it a success? I think it's a success in a way that we say, yes, it can be done, it can be structured. We have to see what results it will bring. We have provided, as we heard from Raimund as well, seed funding to successful players such as Responsibility, but also Swiss Sustainable Finance. So really addressing the market through a platform approach. Local currency guarantees, I think, but maybe you're interested in knowing what hasn't worked out very well. And here, let me just take one example. A project that is very close to my heart, or was very close to my heart, with EBRD and KfW, was the MIDF, the Municipal Infrastructure Development Fund in Western Balkans. Very interesting structure, first loss for infrastructure to municipalities, technical assistance to local banks in Western Balkans. So the whole structure was great, but it just didn't work out because I think the market was not conducive, and then the low interest rate environment just meant that they had other sources of funding. Maybe it was a bit complicated, but it had all the nice ingredients. I think the market was not ready, so we decided jointly to close the instrument, and that's why we're there, and that's why we're ready to take risks. I think that the model can be applied maybe elsewhere, maybe in the same region when the conditions are conducive.
Thank you very much. And I know it's always painful to say what hasn't worked, right? We all want to shine and say, this has worked, this has been fantastic, we have replicated, put it up to scale. So, but I think in terms of lessons learned, we do have also to take stocks of things that haven't worked. And I'd like to maybe hear the KfW experience and on both what has worked and what has not worked. Anything that might be of interest for really in the always with the objective of stressing where private sector capital could have been attracted maybe in a more efficient manner or bigger scale.
Yeah, I think most of things have worked, but also have developed somehow. Mm-hmm. So I mean, we had many lessons learned from the days we started attracting private capital for specific impact investments, and some things also did not work at all. For example, there's one little equity fund in India we launched together with the German government about 6 years ago, with the specific aim to give pension schemes for very, very poor people. Kind of add-on microfinance, and it didn't work out due to governance problem in this fund, and finally it had to be closed down. But this is not so often, fortunately. With regard to the bigger funds and project, I would say what we are learning more and more, we have to simplify the structures, because the experience is that the simpler the structure, especially on the financial side, but also on the impact side, can be provided, the easier it is for private sector investors to come in. Then definitely things like working on liquidity when private sector comes in is crucial, but not so easy to achieve. And also the whole monitoring, impact measurement, I think it's rather difficult to balance the expectations, especially between public investors and donor agents on one side, on the seed capital, and the private investors on the other side. But I think also here what has been helpful in the industry is the whole digitation and digitalization and disruption, which even in emerging countries give you much more opportunities to measure things much more easily than this was 5 or 10 years ago. So I see that on this side also huge developments are happening. So I think you cannot say what works, what not, but definitely it's a development, and it's a development path. And also in terms of type of investments, what we did 10, 15 years ago are not focal now. For example, the whole microfinance industry, KfW played a crucial role when launching all these microfinance funds. At some time was one of the biggest investors, but it's not anymore, at least for plain vanilla microfinance business, it's not needed anymore. In many countries it picked up. There are local structures, so you don't need us like you needed us before. So it's more looking for a new type of financing for de-risking and kind of bridging the gap. What I also often feel is where development banks can definitely help is to, when I talk to C-class investors, donors, classical donors, governments on one hand, and to private investors on the other hand, I feel it's not always the same language they are speaking. Maybe they use the same words, but they don't mean the same thing behind. And I think here definitely we can play a catalytic role to bring these two ends together. And at the end of the day, it's to find a win-win for both sides and to balance the risk somehow.
Thank you. And what about going to Latin America? I mean, anything that you talked about the importance of local currency. Do you have any examples there of that we could build on? So
let me start with one very big lesson that we learned in 2013. Or that, I don't know if we learned it in 2013, we tried to start addressing it in 2013. And it is that the whole approach to working with the private sector that the IDB had was outdated, wrong, it wasn't working. We had a very splintered approach. We had 3 different private sector windows that were working with the private sector, supposedly with, initially, I should say, with clear mandates. But as time went by, the intersection between those mandates started to increase, and we were falling short, especially on 3 areas. On our impact, because we were fragmented Also in capitalizing on the fact that we had a 65-year institution working with the public sector in the region with a lot of prestige, with a lot of capital, which was the IDB, that we weren't taking advantage of from the private sector side. And more importantly, we weren't really focusing on the big picture, on the strategic side. So in January of 2016, we became one institution. And we're trying to solve these three big lessons that we learned, or things that we weren't doing right. So what are we doing in these three areas specifically? On the synergy side, we are organized in a way that part of our new mandate is to fully take advantage of the work of the IDB, to ensure that at the country level we are fully synchronized. We have one single strategy per country, which allows us to really think long and hard on what are some of the tasks and objectives that Karen was mentioning. How do we ensure that this is something that the private sector can do, and what the public sector should do? And we're doing that at the country level, one by one, and we have one instrument now that sets off what the group is going to do on the both the public and the private sector side. And we also share one single country office. So if any of you need to contact us in any of the 26 countries that we're working on, you have one place that you can reach us, and the country representative represents both the public and the private sector. And that's also linked to what I mentioned before on the strategy side. And on the impact side, we designed new tools, took what was working from the tools that we had, and beyond measuring impact at the project level, which was also mentioned by Karen, we put in place what we call our strategic selectivity framework, which looks way before that, that seeks to guide the effort at the very initial stages of origination and look at it from the perspective of the two things that I mentioned before. These country strategies, the country and sector point of view, and also the strategic objectives, which of course include the Sustainable Development Goals. So that's one big lesson that we learned. More specifically, I fully subscribe what Claudia said before. Trying to work with the private sector, there are two things that we are focusing on very closely. One is simplifying the structures, trying to make sure that that our contracts, the way we work, is becoming more simplified, and also standardizing the way we measure impact. Especially, of course, for the impact investing for sustainable finance, it's important that we speak the same language and that we are able to report in a way that our partners can then use to report to their respective governance structures. So those are very important lessons that we learned that we're trying to apply. And also taking advantage of the fact that these separate windows that now became one do have a history of at least 30 years. So trying to bring into this startup with a history, not just the good aspects of being able to start from a blank page and start to work in a different way, but also take advantage of the knowledge and the experience that these institutions separately had working in Latin America.
Thank you very much. And maybe in the interest of time, Nick, I was thinking to move to another question, which is what are your expectations in terms of contribution of a private sector investor? What are we expecting? Are we only after the capital, or are we after expertise, know-how, best practices, involvement of corporate governance, or is the contribution of the private sector totally oversold, and in fact it's only capital? How do you see this?
I think it varies very much depending on what type of transaction it is and what the different parties' objectives are. And if I look at some of the successful partnerships that CDC have had, the answer to that question is, as to what contribution the different parties make can be very different. If I mentioned an example in Sierra Leone, we did a risk-sharing facility with Standard Chartered immediately, or during the Ebola crisis. Though obviously part of that was the fact that both sides were putting up capital, but it was a lot more about the fact that in that particular case, Standard Chartered had relationships extensive relationships in the country, companies that they'd been lending to, an ability to distribute. To originate and distribute credit, a well-recognized sort of a mechanistic credit process. So all those things were important and they brought to bear. We have other examples. I mean, we're in discussion with a major international consumer brands company at the moment, where actually they're bringing almost no money to the table. So it's what they are bringing to the table is a distribution network. They sell products that are used by hundreds of millions of people every day in the markets that we care most about and the ones that we're trying to make the greatest difference in. These are branded products. They're brands that the public know and trust. So bringing that to the table can be a very significant, can in itself create an investment opportunity that might not otherwise be there. We've done a partnership with Lafarge in Malawi, which is a relatively small company designed to make bricks that don't need to be oven baked, so have significant environmental benefits. In that case, the business is actually situated on the same site as the main Lafarge factory. So they're bringing expertise, they're bringing R&D. They're bringing distribution, and they're also bringing capital. So I think one of the challenges about sort of public-private partnerships is that each opportunity is inevitably going to be somewhat bespoke, and the benefits are going to, the role that each party plays is going to be a function of the core strengths of those companies. And it's how you reconcile that almost bespoke nature of many of these partnerships with the point that Claudia made before about complexity and simplicity, because the biggest enemy, the biggest reason these things fail is because they are designed to be too complex. We design too complex governance structures. We design too complex financial structures. We don't look head on at the issue of subsidy and who's subsidizing who and what's each side trying to get out of that and so on, how they're going to measure it. So as I said, I don't think it's as simple as saying private sector brings money. I think the private sector brings a whole host of other things that differently in different deals, and the challenge is how do we capture that and at the same time have structures that are simple enough for everybody to understand and everybody to invest in.
Yeah. Thank you very much. And maybe actually this is a good intro for Ivo, because I know that clearly SECO has created CFM with, among other objectives, really to mobilize via CFM and attract private capital into impact investing. So I guess you can share some experience there, Ivo. Thank you.
Well, definitely, thank you. Yeah, when we created CFM, we deliberately went for a model with a private fund manager. So CFM has a very restricted number of personnel, actually. So we sourced that out first, the portfolio out of SECO, but by choosing a private fund manager, we not only allowed but requested the fund manager also to establish co-financing mechanisms and therefore to attract private funds. So you have the mobilization at two fronts. You have the private fund manager that attracts private co-investments, but you then have CFM through investing in local funds attracting other public investors such as the DFIs, but then also hopefully also private investors. So you have a whole cascade of mobilization, which worked quite well. The mobilization efforts have been successful so far. And now thinking about the role of private sector and what it brings, I think the funding is already a lot. I talked about successes. They're that haven't only been successes. And let me also take this opportunity to say that especially in the SME private equity space for our priority countries in the south and in the east, so the developing and emerging markets, Switzerland is quite a tough market, as we learned over time. Institutional investors, they are quite hesitant to go in. We also see a certain gap between initial enthusiasm and the actual amounts invested. So once a private actor invests and lends itself to a facility, I think that already shows a strong signal. And then we can team up, and from SECO side, we really try and bring in the innovation part of the private sector that we can't bring to the table. The private sector business models, public and private, they need to have different business models. Simplification, I mean, just yesterday we discussed how can we simplify some of the structures, some of the requirements that we have, because we are accountable to the wider public, to the parliament. There are lots of requirements in terms of how to measure impact. So coming up with some ideas, joint ideas, how we could streamline this, and SECO is very active also in trying to foster standards and standardization so that we speak the same language. And I think there a lot can still be done. Talking to private investors, what they tell me is blended instruments, they should per definition be more sustainable than pure grants, since they foster durable assets. But then we all know that there can also be a race to the bottom. And recently I was at the conference talking to blending specialists, and we did a short question round, and 76% of the respondents said, yes, there is some crowding out of the private sector. So, what are we expecting, and what are we bringing to the table? I think it's the openness of trying to identify those elements where we maybe go too far, where we drive out, have a critical and open dialogue of what the respective roles are, where a subsidy element is justified. That's the kind of lesson learned that we took so far, that we need to upfront, right at the beginning, be very open in what the different roles are, what the problem is that should be addressed through a blended finance instruments, and then also design exit opportunities for the public part, for the subsidy part early on.
Okay. That's great, thank you. Maybe we move to another question, which is a bit more sensitive. Last year I was in DC, there were the presidents of all the multilateral development banks, and again the topic was how we can leverage private capital, get engaged with the private sector. And one of the presidents of these multilateral development banks was very open and said, well, but what do we need to change, and how can we, in fact, ensure that the incentives of our staff and of our teams are based on attracting private sector? And I thought this was a great point, because of course, unless you change, I've been in a development financial institution, and unless you change the way my assessment is done of the book of business that I bring in and what is the percentage of the private sector, then it doesn't really trickle down to the teams and to the transaction teams that in the end are the ones, or to the local offices. So how do you do this? So I guess the question to you is, how far are your institutions in really having incentives built in for your teams in attracting private sector? Is this part of their performance assessment? How is it materialized, if at all, and maybe how could be further strengthened, assuming that these then of course allows more private sector participation? And I don't pick anybody here. You choose.
Maybe I'll take a shot at that one. I think it's a good question. Obviously, as you said in your introduction, I spent quite a considerable amount of my career at JP Morgan and Goldman Sachs. There, the incentive structures were pretty simple. If you wanted to tinker the incentive structure, you tinkered the you readjusted the compensation structure, and that had an amazing ability to affect people's performance and what they did every day and what they prioritized. I think the world in which we live in is a lot more complicated. First of all, we don't have, certainly at CDC, and I suspect it in the other multilaterals or DFIs, we don't have a bonus structure. We don't pay large bonuses to people, so we don't have that to work with. And frankly, I don't think that's not why people come and work at places like CDC anyway. It's because they're motivated by the broader development impact. I think you do have some flexibility at the corporate level. I mean, it is true, CDC would like to, I think, historically has never had volume targets from DFID. We've never given volume targets to our employees, but there is an expectation that there will be. I mean, obviously, if the whole organization stayed there for a year and didn't actually invest any money, that would probably cause a problem with our shareholder. But I think there is a sense to which, to the extent that you are using a volume target, I think it is appropriate now, as the private sector becomes more and more into view from a development, as playing a role in development, and there is a strong case for adjusting those volume targets so they incorporate your ability to bring in other money as well. But I think, and then obviously that people do care about their performance evaluation. So having a performance evaluation that reflects that. But I don't think it will ever be as simple as it is in the private sector in the private sector to actually just dial up an incentive structure in a particular way and create significantly different behaviors.
If I may add, on the SECO side, on the public ministry side, we don't have incentives so far, but it could change. I mean, we have, for instance, the climate finance agenda, where there are international commitments, also of Switzerland, and where the Federal Council also says an important part of the Swiss contribution to climate finance will have to come from the private sector. So let's see, a few years ahead, maybe we'll be incentivized. But for the time being, I think it's important that we are not disincentivized to also invest in these kind of mobilization structures as regards to technical assistance, which is our core business and the history of our business. Now, looking at CFIM, yes, from the owner's perspective, we have strategic objectives. They emphasize the mobilization part because we are providing funding, capital, and also from the highest political representation, the expectation is that there will be some increased burden sharing because we see it as a successful model, a successful investment model. As I mentioned before, mobilization has been part and parcel of CFIM's history, and going forward, we would like to see that continued, and we mentioned that also in our strategic objectives. So there is a small part of incentivization also through a small bonus, but it's not that, as you said, Nick. I mean, it's not the extrinsic part; it's also the intrinsic part. And working with a private fund manager, they find this most exciting also to attract private funding because ultimately it also expands their business.
So I very much agree with what Nick and Ivo said. So I think it could be even counterproductive if you fix too much on quantitative incentives in our business. And definitely the DNA of most people also working with KfW Development Bank doesn't come from volume targets, but more from impact targets. We have volume targets, and it's part of the target system, and it's part, at least in the management also, of incentive, but it's not towards private capital, it's toward capital and investments at all. And maybe I can tell you a little story. Since KfW is now being regulated by the German BaFin since 2 years, we're just changing our incentive systems within KfW to be in the lines of the BaFin for the bonuses. We don't have high bonuses, but we have parts of bonuses. And this is really giving us a headache because we can't measure our work like you measure investment banker works. But BaFin and the regulator want to have a clear system, and sustainability and impact, they don't care about this. They don't even know the words. So it's really tricky to find a good balance between target incentives and financial incentives and the sustainability, which is a little bit more the core of our businesses.
I've been informed that we do need to leave some room for questions. So, Orlando, 2 seconds to you,
30.
and then we give the floor to the audience who has been patient.
Maybe half a second. No, just to say that in our case, we struggle with that. We settle on not making the perfect the enemy of the good. We do have a variable pay. Right now is around 3% of our payroll. We expect it to be maximum 10% in the next 5 years. We do have volume targets. And on mobilization specifically, that was part of one of the 5 key reasons why the reorganization was done. So we have very ambitious mobilization targets for the new IDB Invest organization. And therefore, we've done a couple of things, mention them very quickly. One is the principle that a dollar mobilized is exactly the same as a dollar invested. So for people who are working on that, we value both exactly the same in terms of how their targets are, whether targets are met or not. And second, because we have to balance with our development mandate, we have an approach we call the portfolio approach, with measure sports development and finance impact, and we decoupled. The correlation between mobilization and development was very high. We made it lower. So as mobilization in and of itself, it's a good. So those are a couple of things that we've done to try to create the incentives for more mobilization.
Excellent. Thank you very much. So, floor to you. Please introduce yourself. I see already a hand in the back. Red tie, easy to spot.
Hello, I'm Alejandro del Mar from Cornell. I want to make an open question regarding the elephant in the room in large-term investments and infrastructure, which is corruption. We've seen in the couple of last 2 years events like Lava Jato in South America or the 1MDB in Malaysia. And of course, that's one of the challenges we have to make with public sector if we want to develop sustainable public-private partnerships. So I wanted to make an open question of what type of initiatives your organization are being engaged beyond the standards in order to make more sustainable partnerships.
Maybe we take another question so that we... Yes, very far back. No red tie.
This is Daniel Crahan-Wolf from Foundations and Sustainability. No, don't. I have a question regarding Nick. You mentioned the gap between initial enthusiasm and investment after that. Where do you see the reasons for that?
Thank you. And I guess we can take a third question. Yes, a lady in the back.
Thank you.
Kindly introduce yourself.
Yes, good morning. My name is Chichi Macy. I'm from the SDG Lab. It's a unit in the United Nations office in Geneva. From your panelists, which their presentations were excellent, one common thing I saw was that you all agreed that there was a need to simplify the structures or processes or procedures. If you could share one initiative you think would have an impactful result in this simplification of the processes, what will that be? And would any of your organizations be open to a multi-stakeholder initiative to try to cause this simplification of the structures or procedures? Thank you.
Great, thanks. So I guess we start with the, as you said, the elephant in the room question. And I saw that Ivo was ready, all warm. He wasn't ready, but now he is.
I have to be, yeah, of course. No, I think this obviously addresses a very important issue for us, since we work and we've been working in the infrastructure space for a very long time. What we've done recently is bring closer together my team of macroeconomic support and public finance management and infrastructure. We see that tackling corruption goes way beyond all what we've established in procedures and tender procedures and looking closely into how this works and increasing transparency there. If we want to tackle the underlying and systemic problem, we have to increase the transparency in the whole public finance space. So these days, when we look at infrastructure transactions, we look what is the broader environment, how does the sector look, and how could we and it starts with maybe budget support operations right at the top, but then also, especially in the subnational sphere, where could we support local governments in increasing their transparency? We have some diagnostic tool there. We adapt those tools to the specific needs of the infrastructure line ministries. So it's really bringing together the different expertise of different players. I think that's one area how we try to move the whole market forward and over time reduce corruption, which we all know is part of the reality, especially in infrastructure.
Thank you. Nick, there was a question really for you. So yeah. I guess I have to pick you.
Yes. So the question, I think, was about as I understand it, why so often we have a real initial enthusiasm for transactions or ideas, and then very often they don't lead to investment. And what goes wrong? And I think we've covered some of those. A number of those already. One of them is people have very interesting high-level ideas, but actually putting them down on paper and executing them, putting a structure in place that satisfies everybody's governance requirements, everybody's return requirements, becomes a very complex undertaking, and very often, as you go through the process, things fall away. A lot of that is, I think Ivo said earlier on, a lot of that is because we don't spend enough time at the beginning answering the tough questions. Where particularly when we're talking about blended finance vehicles, where people are putting up or taking different positions in the capital structure, taking higher levels of return, higher levels of risk for lower levels of return. We really need to bottom those discussions out early, rather than go down the road with very good intentions and end up getting to that at the end and realizing we don't have a match. I guess I would also say, this is a broad comment about the impact investment movement as it's developed over the last 10 years. There's no doubt that there's been an awful lot, a great deal more talk and hype in the impact investment movement than there has been capital moved. It's been extraordinary how the idea, that's sort of the notion that investors should, as part of their investment philosophy, should consider impact. That idea, which almost didn't exist 10 years ago, is now becoming almost mainstream among investment managers and many of their clients. And I think that's a really good thing. It hasn't perhaps developed. I think Ivo mentioned social impact bonds earlier on. Those particular structured impact investment instruments haven't developed as quickly as many of us would have liked or hoped for. And I think a lot of that gets back to the complexity question. But I don't think we should lose sight of the fact that impact investment movement is now a term that hadn't been invented 10 years ago, is now very much a part of the mainstream. And that idea of asking about what impact does our capital investment decisions make on people's lives is something that is as I say, becoming almost mainstream, and I think that's a very good thing.
Thank you. And on, I guess, simplifying structure, since Claudia, you started this, now I put it back to you, and I think the question was also the SDG Lab, I guess part of the UN in Geneva was asking if there are possibilities of actually, participating, partnering in sharing, this knowledge and this know-how.
Yeah. Okay, so let's take for one specific example, because you asked how to simplify. So I said at the beginning that we're very much involved in this structured Luxembourg funds, and normally these are structured in 3 layers or even 4, where you have a notes layer, then A shares, mezzanine, and seed capital C-class shares, first-class shares. And then you have a very complicated waterfall structure for the return, which depends on the class you are invested. And the experience we have had with this kind of structure is that in most of these funds, and with very rare exceptions, the private sector loves the notes, but doesn't want to go for A shares or B shares. We have some few exceptions, but it's not the rule. And we also see that the whole financial structure of these funds, the waterfall, is so complicated that even the accountants of the funds sometimes take 2 years to understand how to book the waterfall. So definitely this is not a structure facilitating it, and you could simplify it as much, having maybe 1 or 2 layers, with the same benefit for all the others. So that's kind of a very specific thing we could simplify in future, and we are starting to simplify in order to make it more transparent for private investors, especially if these are small private investors like foundations. It becomes even more complicated to understand these structures. With regard to stakeholder involvement, yes, and we have been doing this in some funds. For example, in GCPF, we are working together with UN organizations on the technical assistance side to kind of benefit each other from different baselines on CO2, CHG emission in countries where we then could work on it, and we don't have to double the efforts. So I think also for SDGs, there are parts where we definitely could join hands and look at it, but it will always be specific to the product. I feel it's a little bit difficult, or at least in my imagination, to have kind of a very general approach.
Yeah. Perfect. Thank you. So thank you to all the panelists. Great input. Thank you for really sticking to the time. And I guess we give the floor back to Sabine, who is going to manage all the way through the rest of the conference. Thanks a lot.
Thank you very much. Thanks to all the panelists from my side as well. We've heard a lot of different aspects. Some of the takeaways I take with me are that complexity really is an issue, that you have to face reality in that if interest rate is too low, it mightn't be sensible to go into a market. But then we heard really encouraging examples of how public sector entities really manage to mobilize the private sector, and good to hear that in the incentive schemes it's even the same value to bring in private money as to invest your own money. So thanks a lot for this. We now heard a lot about partnerships already. I guess you're ready for a break. We'll be back here in this room at 11:30 for the private sector panel. So we'll get the other perspective in the second part, but now please enjoy your coffee break out in the hallway. Thank you.